Open up any social media feed, and you will see traders glued to flickering screens, searching for short-term chart patterns to predict daily price movements. But this high-speed approach rarely works. As this breakdown shows, more than 95% of day traders actively lose money. To actually generate wealth, you have to abandon the gambling mindset and use fundamental analysis. This requires treating a stock purchase like entering a 3 to 10-year business partnership. You are buying a piece of a real company. Every share you acquire acts as a physical building block, slowly constructing a resilient financial foundation. Before you trust a company as one of your building blocks, you have to verify its structural integrity. Your first filter is the balance sheet, which reveals if a business can survive short-term economic shocks. You determine this solvency by taking their total current assets and dividing them by their total current liabilities. You want this ratio to stay comfortably above 1, proving the company holds enough cash to cover its short-term debts. Next, you check the income statement to ensure they are actually making money. Once you subtract operating expenses from total revenue, you are looking for a healthy operating profit margin, sitting between 5 and 20%. Finally, you inspect the cash flow statement. A safe company generates positive cash from its everyday operations, rather than borrowing heavily just to pay out unsustainable dividends to shareholders. If a single stock cannot pass these 3 mathematical filters, solvency, profitability, and positive cash flow, it is too fragile to include in your portfolio. Pure mathematics will only get you so far. Spreadsheets fail to capture the invisible structural vulnerabilities that qualitative analysis reveals. For instance, a globally recognized brand like Apple carries built-in consumer trust that obscure competitors lack. This recognition acts as a protective shield, locking in a massive customer base and minimizing your risk as an investor. Companies also build physical competitive advantages. Sitting behind the wheel of a Tesla, you're interacting with proprietary technology and a vast charging network that makes it incredibly difficult for rivals to steal market share. Yet, even with a strong brand and proprietary tech, a company is vulnerable to leadership risk. A single erratic executive or a high-profile politician can instantly destroy market value, regardless of how solid the balance sheet looks. In 2016, Donald Trump tweeted that the cost of Lockheed Martin's F-35 fighter jet program was out of control. That single post erased nearly $4 billion from the aerospace company's market value in one day. A mathematically sound balance sheet is useless if the company is constantly disrupted. You need a qualitative moat and sensible leadership to protect your investment. Once you have vetted your individual companies, you have to assemble them. A lasting portfolio balances slow, reliable assets against volatile, high-upside ones. On the stable side, you have value stocks. This array of Procter & Gamble products represents companies that provide everyday necessities, thrive during recessions, and consistently pay dividends. On the volatile side, you have growth stocks. These companies trade at high price-to-earnings ratios and rarely pay dividends, choosing instead to reinvest all their cash into capturing future market share. To balance these forces without taking on excessive risk, apply 2 strict diversification rules. Never allocate more than 5% of your capital to a single stock, and never put more than 20% into a single sector. Zooming out, a healthy macro-level architecture requires at least 25 individual stocks, spread across a minimum of 5 different sectors and 2 countries. This strict diversification operates as a structural shock absorber. If one company or an entire sector suffers a catastrophic failure, the rest of your portfolio holds firm. You can build a mathematically perfect, fully diversified portfolio and still lose everything if you lack emotional control. Your biggest threat is the urge to panic sell during a negative news cycle. In March 2018, the Cambridge Analytica data scandal broke. Investors panicked over the unethical use of personal data, and as this chart shows, Facebook's stock plummeted 18% in just 10 days. But zooming out, that terrifying drop was merely a tiny blip. Investors who held their positions wrote a massive 200% upward trend over the following years. True financial stability requires 2 equal halves. You need the intellectual rigor to build a mathematically sound portfolio and the emotional discipline to let it work through the storm.